All right, welcome. In this explainer, we're going to dive deep into the powerful, time-tested ideas behind long-term investing. The principles that have been proven time and time again to create real, lasting wealth.
So let's kick things off with a question that honestly probably hits close to home for a lot of us. You do everything you're supposed to do, you work hard, you put money aside, but does it ever feel like you're just spinning your wheels financially? Like you're just standing still? This question is really the perfect place to start.
On the one hand, you've got what feels safe, right? Cash sitting in the bank. You know exactly how much is there, it's predictable. But then there's the silent reality that's always at play. Inflation is constantly, quietly, eating away at the value of that money. So what feels safe today can actually become a guaranteed loss over time.
And that right there, that's what we call the saver's dilemma. Let's really dig into this hidden cost of playing it safe with your money.
Okay, so how do we solve this dilemma? Well, there are basically three main paths you can take, three different vehicles for your financial journey: stocks, bonds, or bills.
Let's break these down because each one is a totally different trade-off. With bills, you get safety, but your money pretty much just keeps pace with inflation if you're lucky. Bonds give you a little more return, a bit more growth with some stability. But then you have stocks. Stocks are actual ownership in real businesses, and that's why historically they've delivered the highest long-term growth needed to build real wealth. You're tying your money to the innovation and success of the entire economy.
And look, this isn't just a hunch or some hot take. The lesson from history is just crystal clear. When you zoom out and look at the data over decades, stocks have consistently been the most powerful engine for wealth creation. It's not even close.
Okay, so if stocks are the obvious long-term winner, why are so many people kinda scared of them? Well, it all comes down to one word: volatility. So let's tackle this beast head-on and talk about why those daily ups and downs are not the real risk you should be worried about.
This is where we have to make a really critical shift in our thinking. Day to day, month to month, sure, the stock market is totally unpredictable. But when you zoom out and look at the long term, we're talking years and decades, they become amazingly reliable. You have to separate that short-term noise from the long-term signal.
And this chart just shows it perfectly. Check this out. If you're looking at stocks over just 1 year, yeah, the chance of losing money is pretty high. But stretch that out to a 5-year period, and that risk drops significantly. Now look at a 20-year period. The historical probability of losing money in a diversified basket of stocks, it's basically next to nothing. Time is the ultimate risk reducer. It smooths out all those scary bumps.
All right, now that we've kind of defanged the whole idea of risk, let's talk about the single most powerful tool you have on your side. And guess what? It's not about being a genius stock picker or timing the market perfectly. It's simply about time.
Because time is what fuels the absolute magic of compounding. This is that incredible process where your returns start making their own returns. It's not simple addition, it's exponential growth. It's growth that builds on top of itself over and over again. The best way to think about it is like a snowball rolling down a really long hill. It starts super small, you barely even notice it. Your first investment earns a little bit, and that gets rolled back in. Then that slightly bigger amount earns a return. But over many years, that snowball picks up more and more snow, and eventually it becomes this unstoppable force of financial growth.
This is probably one of the biggest, most counterintuitive ideas in all of finance, so I really want this to sink in. Most people think that the longer you hold on to something, the riskier it gets. But with a diversified stock portfolio, it's the exact opposite. Time is the thing that systematically reduces your risk and unlocks your potential for growth. Okay, so we've talked a lot about the why, the big ideas behind all this. Now let's get super practical. Let's talk about the how. How do you actually put all this into practice with a simple system that works? Because here's the secret. Success isn't about finding that 1 in a million stock. It's not about being a genius or trying to predict the future. Real, lasting success comes from building a simple, disciplined system and just letting it do the work for you over many, many years.
And here it is. This is the whole shebang, a simple 4-point action plan. First, diversify. Don't bet on single stocks. Own a piece of the whole market with low-cost index funds. Second, invest regularly. Just automate it. Buy consistently, month after month, whether the market's up or down. This takes emotion completely out of the picture. Third, keep your costs crazy low. Fees are like a constant anchor on your returns. And finally, and this is the most important one, stay the course. Just remain invested, trust the system, and let time and that compounding snowball do all the heavy lifting for you.
So here we are, right back where we started, but now we're looking at risk in a whole new light. The biggest risk you face isn't the market going up and down. The real risk is standing still, playing it so safe that you never let your money actually grow and you let inflation win in the end. So the real question isn't what the market's going to do tomorrow, it's what journey are you going to choose for your long run?